Welcome back, everyone. Now, I know on this channel, more often than not, I speak about stocks where the goal is to try and get return on capital, meaning get the share price up, basically. And I believe that that's what probably more of you are here to see than not. Now, today is really no different because while the two real estate investments I'm going to discuss today are have they have some nice dividend yields, and they are owned not only for share price appreciation but for income as well. But I believe that both of them will see some share price appreciation, and I will outline in this video why that is, how that is, and what the stocks are. So the first stock I want to talk about today is Artis REIT. Now, Artis trades currently at under 70% of book value. Now, forgive me if by the time you see this video, if that changes dramatically. It could be 65 as it was a few days ago, could be 2, unlikely, but could be. You never know. So, as always, look at the numbers at the time of that you see the video and not the ones I use. And again, non-investment advice. This is, however, one investment that I own for, like I said, income plus capital appreciation. Also, I'm not going to talk about the dividend yield. You can see that basically anywhere you look at stocks. But the AFFO, adjusted funds from operation, yield is 9.5%, meaning that is basically what they could afford to pay out in dividend yield. Now, what they do with some of the money, whether they use it for buybacks because they're trading at a discount to book, whether they use it to pay down debt, whatever, grow the business, who knows? Well, they know. But the point is, that's what they could afford to pay out if they were paying out everything. But they're not. Now, Artis, just like the other stock, and we'll get to that later, is a bit of a turnaround story. You see, they used to be stuck. They were paying out basically 100% of what they could afford to pay out, and so the equity value, the stock price, was flat or slightly slipping, and there was risks for if something goes wrong. But the point is, they kept the dividend too high. Some situation, some was their fault, some was not their fault, but point is, it was unsustainable. Was a big dividend company, which is nice for some people. But what they decided to do, because they were trading at a big discount to book, is they said, okay, we're not getting the value for the assets that we have. What we're going to do is we're going to cut the dividend in order to focus on per unit growth instead of just growth. And I think that's a good thing, because when you look at a lot of companies, a lot of mergers out there, two companies just jam together and you have one bigger company, but it doesn't really benefit the shareholders. In this case, they saw that they were trading cheaply versus what they believed that they were worth, and that the market wasn't giving them some of the value that they should have. So now that they have added cash flow that they're not distributing, they are able to work towards fixing that discount and add value per share, per unit, instead of developing for the sake of being a developer, but not really gaining any value. So how are they doing that? Like I said, developing for the sake of developing doesn't really help. But developing for the sake of growth per unit, as I'll get to more in a bit, is useful. And so how they decided to work their way out of the position that the market didn't like. The market thought of them as Alberta centric, as oil centric. Although in truth now, not really anymore, because they have grown out of the stigma that the market seemed to put on them. And they are fairly diversified now, and they are continuing to grow in locations, in the markets, in the specific type of real estate that they believe will benefit going forwards. As you, as many of you I'm sure know, you can't it's not necessarily that quick to turn an apartment building into an industrial workshop. So there has been forced or directional changes as well, but in principle, growth in the areas that they want to grow. And along the same line of thought, the market has really not been kind to retail. And whether that's completely justified or not, the view of artists has been to expand in other areas. Maybe they believe that retail has been overdeveloped. Maybe they believe that retail is declining. I suggest if this investment interests you, you look at the specific real estate that they own. Again, retail, shopping centers versus malls, different things are completely different things with potentially different outlooks as well. So go by a case by case basis if it interests you. But point is here you could see that they're transitioning more towards industrial, which um, seem to get is a bit more of a growthy area in real estate, it seems, and gets the better valuations in general. And so you can see that they really are diversified, whichever way you look at it, and they're not overly exposed to the hated areas in the market that have the market doesn't like the prospects, unless I guess you think that due to Zoom and due to whatever, that office is in terminal decline. I'm skeptical on that, quite skeptical. We'd have to see what happens after, but I don't see it happening that way. But everyone has their own view. So I did mention before that they are growing into target markets, like these are some of their new developments, industrial in the US, as opposed to the Canada, Alberta focus, where they were, or the market still kind of stigmatizes them as being. So I thought today I would go a little bit into the numbers. Normally I do focus on numbers. However, don't really discuss them because everyone has their own target yield and different whatever. And really, it's not for me to say this number is good, that number is bad. But anyway, today, yield. Point is here that you're not only getting something that's at a discount to their book value, but you're also getting some big cash flow yield from a REIT. And the point is, REITs, I mean, everyone has their own idea of what's super risky and what's not risky, but real estate has been a good investment over time and has been successful in, well, throughout time and throughout currency devaluation. And so if that were to be a theme in someone's portfolio, well, this is a decent way of doing decently if that were to happen, and decently if not. And that's the point here that I wanted to bring up with the big, decently, well, good cash flow yield, really. As I mentioned before, whatever the dividend yield that you're seeing on your app at the time of looking at this, that's not them paying out all their money. That's them paying out less than 60%. Going forward, I think they'll probably increase their distribution and pay out 60% next year. Maybe we'll see this their target. But the point is that leaves them with 40% of their cash flow to provide returns in other ways. They can continue with the buyback because if you're buying back something at a 30% discount to book value, you're adding value. You're buying a dollar for 70 cents. That's generally positive. They can increase the distributions again. Hopefully they don't get in the same trap as before, but they have decent, I mean, they're not in debt trouble. They're not in needing to cut dividend trouble. They seem to be, to me, on the right track, and there is plenty of room for them to grow per unit. Now, owing to this discount, there is a bit of a board battle going on right now. So if this investment interests you, I suggest reading up on that and developing your own point of view on what's going on. I'm not going to go too deep into it, but needless to say, sometimes when different people believe there's value still on the table, unrealized value, there's different ideas of how to realize that. And so I really suggest you having a read through. So stock number two, some of you might not be surprised because I did make another video on it. And if you're interested after hearing what I have to say here, maybe you want to check that out. But I'm going to try and say different things today. Anyway, longest intro in the world to Melcor Developments, a company that trades at a serious discount to book, currently at 0.22 times book. That's 22 cents on the dollar of their book value and a nice dividend to boot. Thing about the dividend is that is not even close to the maximum they could afford to pay out. Yahoo says the payout ratio is 44%. I could argue that it's 33, but either way doesn't necessarily really matter. Point is, they could, if they wanted to, if they were only interested in paying out dividends, they could pay out much more. Now, the first obvious reason as to why they trade at such a big discount, in real estate, location, location, location. Obviously, they must be in a terrible place. Richest province in Canada per capita, the place with the lowest taxes and highest wages. Sounds terrible. Now, obviously, I'm joking about that. Love you guys in Alberta. Many of you said hi after the previous video, Melcor. Really appreciate that. But anyway, for whatever reason, the market has decided it hates Alberta. I am not entirely sure why. Well, I mean, I have obvious reasons I'll get into, but I don't think it's that bad. Look, I mean, I know Alberta is oil central, and it has gotten a big knock over the years of low oil prices, of oils going away, that story. But realistically, is the world going to be able to survive without oil? Let's say yes. Okay. Well, then the economy is going to have to recover without oil in this scenario, meaning, well, Alberta will recover in some ways, or as I think is highly more likely, there's going to be a recovery in oil, and all of this hate on oil will become okay, well, we still need it. So either way, I mean, I think that the region stands to recover. But what other reasons could there be for a company to trade at such a big discount? Well, maybe their earnings suck. Maybe they're losing money and maybe they're on a downward trajectory. Except they're not, and not here at least, not in their book value at least, because, like I said, when you are not paying out all the money that you could, it means that in theory, you're probably using the rest to grow the company. And they have. They have been growing book. Now, obviously, this year has been a bit of a challenging one, not unique to this company. But in general, the trajectory has been decent. And yeah, the returns are not super steady. I mean, it's not a quarter business where everything's the same all points in the year, but they have been moving generally in the right direction in this case. And yeah, I suppose you could also say that the returns that they have gotten on the assets that they have not been spectacular in recent years. But remember, they've also been fighting off the challenging times in the region. So when accounting for that, I mean, this is a company that has a simple, yet oddly in this diagram, highly roundabout business model. And they buy land, develop it, and sell most, but keep some. And they can roll that into success and then hopefully more success over the build, sell, keep income cycles. And another point is this is not necessarily a one-trick pony company. They are diversified. They have a lot of different income stream asset sub businesses, if you will, working for them. And you can see here in terms of where their funds come from, and fairly diversified, including some from the REIT where they own the Melcor REIT, where they own a controlling interest. And so they can influence the direction there. This is the parent, if you will, company. And while it is necessarily a good thing to be skeptical about companies that trade at such a extreme discount to their book value, it's always good to be skeptical of, well, is that book value actually reflective of the assets they own? Maybe, maybe it's slightly exaggerated, who knows? There's always skepticism when something's trading at a discount, and when something's trading at a premium, people just ignore that because times are good and no one cares. In this case, though, I do feel like it's relevant to mention that recently there has been insider buying. So whatever the price that people think the assets should actually be worth, insiders think that this is cheap. And this is just the example of one of the insiders that's been buying a decent amount recently, considering the volume that trades in the company. But there have been others, and they are slowly adding value by buying back their assets at 22 cents on the dollar. And so this is decent trajectory for now at least. So really, Melcor is a company that is dealing with a number of tough narratives, but I think is a tough company also, and I think they should be fine. I don't know when they realize the value or if they realize all of the value that it looks like they may. I just think that it is an unjustifiably cheap company and should have some nice returns in the future. Don't know when, but I'm prepared to wait on that. So that is basically all I want to say about today's companies. Again, disclosure, I do own both and am not in a hurry to sell either. With this type of investment, as I say, I kind of enter into them with the mind frame of mind that I'm going to hold forever unless they get expensive, in which case I'll trim or sell or some amount. But the thing is, I wasn't super promotional with the names that I talked about in this video because I really do like them, but in value, often, especially with things at high discounts or medium discounts, you're looking for, okay, it's not that bad. And it can actually improve in this way. And that's what I see in this companies. And that's really what I want to get through. With that, I hope you enjoyed, and until next time, have a great day.